Hey, everybody, Russell Gray, co-host of the Real Estate Guys radio show, and we're here for another edition in our Silver Series, which is the series that Dana Samuelson and I did on just making sense of silver and how does silver work and why is silver interesting, especially to real estate investors. But we're also going to be taking on some questions. So we're happy about taking the questions. We're going to start with kind of a boots on the ground market update. And so here to do that with us today, of course, is our good friend and precious metals guru, Dana Samuelson. Hey, Dana.
Hi, Russ. Great to see you.
Yep, it's great to be seen. We just got done coming out from a live event, and here we are at the end of the beginning of the second quarter of 2021, and we're back in the live event business. Excited. There's going to be a New Orleans investment conference this fall that's going to be live and in person. That's where we really got to know each other. Excited about that. We have our investor summit at sea before that in June. I think you're going to be there. Brian London, another gold expert, is going to be there with us. So excited about that. And we just got done doing our Secrets of Successful Syndication, and we had 270 people live there, and they're super excited. So it feels like the world is kind of getting back to normal a little bit, at least as far as being able to go out and mingle with folks. But of course, the financial markets are still under a lot of stress, and they're doing weird things. And sometimes you scratch your head and you wonder what the heck's going on. And as real estate investors, you know, we care about accumulating wealth and equity in real estate, and equity in precious metals is another place to park equity on your balance sheet. I make the argument it's actually better. And then there's just what the precious metals market says about the strength of the currency and the financial market. So, you know, we broke down a lot of that in the Silver Series. So folks, if this is like your head is spinning and you're like, I don't even know what these guys are talking about, just send an email to SilverSeries at realestateguysradio.com, SilverSeries at realestateguysradio.com. And then we'll send you the link and tell you how to get to the Silver Series. And in that, you can submit questions. And then as we get questions, Dana and I get together and answer those questions, which we're going to do today. And we'll just keep doing that as long as you send questions. We're gonna, you know, get together and work on answers. But for those of you that don't know Dana has been in the precious metals business a long time, and he actually worked alongside one of the legends. I mean, the reason you can even own precious metals is because of the late, great Jim Blanchard. So Dana, take a few minutes and just tell the folks who don't already know who you are, kind of who you are, what your background is, and why you're qualified to have an opinion on the topic.
Well, thank you, Russ. Appreciate that. I got my first job in the precious metals business right out of college in 1980, working in a vault in Houston, Texas, counting, shipping, weighing physical precious metals. You know, the people in the office got their quota in dollars. I got mine in tons on how I had to move stuff around. We sold coins and classic silver dollars back then to Blanchard and Company, a big company in New Orleans, biggest mail order company in the business. And I ended up getting hired by Jim Blanchard in 1983 to become a coin grader, an expert appraiser. So I went to work for Jim. I sat in a vault for 2 years looking at old vintage US coins, learned to become an expert appraiser. And then they moved me up to their trading desk, where I spent $50 million of Jim's money every year with the industry. So I got to know all the industry players. So that I really had probably one of the best formative experiences anybody can have in the business. I started my own company after I finally realized I had enough experience and connections to do so in 1998, American Gold Exchange. We've been in business 22 years with a flawless business record. I've been giving back to the industry as well. I'm a member of the Professional Numismatist Guild, which is the leading organization of rare coin dealers in the country.
I think you get a prize just for being able to say the word.
Numismatist.
It's like aluminum.
Yeah, exactly. So I'm a past president of the P&G, and during my presidency, I helped to conceive of and establish the Industry Anti-Counterfeiting Task Force, which today works with Secret Service and Homeland Security and various mints around the world, including the U.S. Mint, to interdict shipments of fraudulent precious metals coming into the country, primarily from Asia. And they come in through online auction platforms. So it's really best that you work with a long-standing dealer like myself, preferably a P&G member, because we have a binding code of ethics that we have to abide by. Another thing I've done is I recently worked with the Commodities Futures Trading Commission to help them analyze sales that were made by a company out of California that was allegedly defrauding precious metals buyers by overcharging. That's an ongoing legal battle right now, but it was the largest joint action between the CFTC and individual states in history. And the total is $188 million. Not all of that is fraud because there's underlying precious metals value, but it was allegedly overrepresented by quite a bit. And my declaration of fact in that case has been used by state attorney generals around the country now to help identify other particular situations. So they're using what I wrote in that case as a roadmap to figure out what's right and what's wrong as far as precious metals pricing.
Yeah. So now you know why I love Dana. Dana's a smart guy, clearly qualified to have an opinion. And I think that's one takeaway is that, he's been in the business a long time and he's considered to be an expert by, legal authorities. And he's been in the business and in the profession in the organizations for quite a while, held leadership roles. But the other thing is you just have to understand there's a lot of counterfeits. There's a lot of bad stuff out there. So, don't be running around on eBay and thinking you're getting a deal because you might be buying something that you won't find out is worthless until you go to cash it in and you find out. And sadly, we hear those horror stories. And so, because the real estate guys aren't really precious metal people, we're equity guys, and we use real estate to create equity and we use precious metals to protect it. And that's a whole different discussion. We're doing a whole series on that Dana's been a part of. And so if you don't, we haven't quite got that out as of this recording, but it's almost done. It's almost done. I've got like 14 of 17 videos done. So we're almost done. But if you're interested in that, you can send an email to PreciousEquity@realestateguysradio.com, PreciousEquity@realestateguysradio.com. And if you've been on that list waiting, it's coming. We haven't forgotten. We're working on it, but it turned out to be a little bit more complex than I thought. But the point is that if you're not familiar with the precious metals market, it's easy to think that it's a trading vehicle. I'm going to buy low, sell high, make dollars, and it's the same thing Robert and I talk about on the real estate side. Real estate investing isn't buying a property low and selling it high. It's accumulating streams of income. Well, obviously gold doesn't cash flow. It has a different role in your financial strategy. And it's more like the role of what equity plays in a real estate investor's balance sheet. But real estate equity is subject to a lot of risk because it's attached to the property, which creates liability, is subject to foreclosure, taxation. I mean, the list goes on and on. But if you can separate the equity from the property and store it in another form, like gold on your balance sheet, that can be a great way to go. So we're out there talking to people about these ideas, but they don't know gold. And when you tune into the gold stations, it's not like the world needs another YouTube video on precious metals, right? I mean, there's like a bazillion of them. But a lot of people look at it as a trading vehicle, or they get so lost in the weeds and the nuances of what's going on in the macro. We're going to talk a little bit about that, you got to keep it simple. To me, it's just really simple. Precious metals is money. I want to accumulate as much of it as I can. And I'm glad when the price goes down because it means it's on sale and I can trade my dollars in. It's like buying a property with forced equity or found equity where it's selling below its actual value. You can buy it at a deal. And then later on, when it returns to where it's supposed to be, the equity comes right back. I mean, Dana knows his phone rings from me when the market is tanking. Everybody's selling. And I'm like, great, back up the truck. So I wish I could back up a truck. I could back up my little cup and, put a few coins in it. But at the end of the day, they add up. You do that over a period of time. Anyway, so Dana, what we want to do is we want to kick off with a little bit of a market update. I've got a couple of things I wanted to ask you about, but I think you're going to comment on them. I want to talk about three things and we can just take them one at a time. One is just what's going on in physical. And and that's manifested in the premium. So the physical market versus the paper market, which we discuss, we need to give an overview of, but which we discuss in the series, and then how that's manifesting in premiums. You said you had some kind of updates on premiums. Then we'll talk a little bit about what's going on with the dollar. So talk to us about what's happening in the physical markets and premiums.
Well, just to set it up, the paper market is the futures market where gold and silver are traded on paper in contracts on the COMEX exchange. And this is industrial strength trading for speculators, but that's really where the precious metals prices come from, how many buyers and sellers there are, whether they're running it up or running it down. Now, the physical market, actually, they take that silver and gold out of the ground. They have to fabricate it into pure metal or specified metal for 90% pure, which is the two purity ratings, either pure or 90% pure. Most fabricated metals are, and then make it into a blank and then strike it into a coin or form it into a bar. So that's how we get physical precious metals. And there's a minting charge for that, transportation charge, small profits. It's a very, very competitive market, as you know. But we've been in a physical squeeze.
Well, before you go there, I just want to make sure everybody understands. That's why when you look at what the spot price of gold is or the spot price of silver is, and you go, well, I can't go down to the coin shop and buy a coin for that price. You can't, because that price has no basis in the real world. It only works when you're trading paper contracts in the futures markets. So unless you're playing that game, that isn't really the price. The price that you pay is the price that you pay in the shop from a dealer, from Dana, wherever you go to get it. That's the real price. That's the street price. And that price has some manufacturing costs involved in it, but it also has some supply and demand costs built into it. So premium is both the cost of actually turning the metal into a physical coin, the profit of the dealer, and the whole supply chain that gets it from, you know, the ground into your hand. And then the third thing is the extra premium on top of that you pay when there isn't really physical metal, because they can create as much paper metal as they want. In other words, they can write a contract like, you know, I mean, if one of the things, for example, if I wanted to show an asset on my balance sheet, I could just put a note receivable on it. And all of a sudden it looks like I've got something on my balance sheet, but I fabricated it out of thin air.
Right.
So this is the game that goes on in the paper market. So you can't judge that, but in the physical market, you have to take into consideration there's always going to be a manufacturing and distribution premium. And then the premium delta that we're going to talk about, the fluctuations really are results of supply and demand. Did I get that right?
Yeah, that's correct. That's correct. So under a normally supplied market, you know, premiums are not very high over the intrinsic metal value. Like, as I said, it's a very competitive market, but we've been in a supply squeeze since COVID erupted a little over a year ago now, because the mints around the world cannot operate these tightly packed facilities and social distance properly. So the available product coming out of the various production facilities, whether they're sovereign mints or private refineries or manufacturers, has been hindered a bit at a time when demand has been higher than normal because of the pandemic, the economic closures, the money printing that's going on. People want more precious metals now than they wanted 2 or 3 years ago. So we have a supply and demand imbalance where there's more demand than there is supply during a time when the mints cannot keep up. So normally if the US Mint would get behind, which is not unusual in tight situations like this, the Royal Canadian Mint would pick up the slack, or the British Royal Mint would, or private refineries in Switzerland would, but they're hampered too. So we have that supply imbalance. And it's been most acute with the US Mint because on top of all of this, they're changing designs in July for their gold and silver eagles, which have had the same exact design since 1986. They're going to change that up a little bit for the first time in, 36 years. But they're doing it at a time when there's not enough product to start with.
Coincidence? Perhaps?
Yeah, just
sorry, I'll take my tinfoil hat. I'll just put it over here.
Well, part of the reason they're doing it is to keep up with the to anti-counterfeiting, to add anti-counterfeiting elements to the design, which the US Mint has not done yet. And that's part of what the task force that I helped to establish got them to do 2 years ago. We said, hey, you've got a problem here. You need to update this. So they're finally reacting, but they're doing it at a very inopportune time. And
Gotcha.
What I've been hoping is that the US Mint would make enough of this type 2 design, because it's a second design for the 2021 issue, and release enough silver in particular, where the supply is most imbalance is most acute, in July, to help really put a new burst of metal into the hands of people and help push the premiums down. But what I've really just learned this morning in talks with colleagues is they're not going to have enough to alleviate this demand imbalance. And the supply squeeze that we're going through now is not going to abate probably till late in the year, if at all. And I do think we will see higher premiums for silver between now, it's April 1st, and August or September, because the other world mints can't keep up well enough either with demand. And at some point in time, there really won't be enough physical silver to go around at any reasonable prices. I think we're heading into that situation. And I don't want to be a Cassandra, screaming at the top of my lungs, this is a problem. But I think this is a real issue that will create even higher premiums than we're seeing now, which have been coming down just a little bit, but now they're firming back up again. It's not going to get easy. This dip that we're seeing in precious metals prices over the last couple of weeks, in particular, because bond yields have surged, is creating even more buying activity. Value shoppers like yourself are coming in hard, and they're creating more demand supply imbalance. So we're not going to get out of this silver squeeze as quickly as I thought we would. And I thought when we talked in January, we'd be out of it by now, but no, that's not going to happen. And it's probably going to get worse before it gets better.
Okay, so the premium increase, of course, pertains specifically to physical, and the shortage is specifically physical. Does the physical shortages, does that show up in the spot pricing at all?
No, not at all. If it were to show up there, the prices for gold and silver would be 10% higher than they are now.
Okay. All right. That's what I thought. I just wanted to make sure that I was clear on that, because again, if you look at the little tickers that run all the time and you're looking at the spot prices of gold and silver, some of the real world activity, supply and demand issues don't show up because they can manipulate supply and demand through the futures contracts. And I'm not saying that they manipulate it for some nefarious reason, but by definition, when you're naked shorting or when you're purchasing, anytime you're trading options, you're dealing in something you don't actually physically possess. You have an option to possess it, and there's a counterparty. And of course, where the real short squeeze could be, if anybody ever trading those paper contracts was ever to stand for delivery and say, hey, back up the truck, I want my silver. Now they have to go into the physical market and source it. And this is the danger. You think the GameStop thing was dangerous for those people. If you're that short silver and somebody actually makes you deliver, then what do you do? Because you got to go in the physical market and source it. And there's a big gap between the price in the spot market and the price in the physical market. And so don't feel like you're being ripped off when you go into the physical market. You have to pay a big premium. It's like $10 on a silver eagle, right? I mean, it's pretty substantial. It used to be like $1.99,
Well, $3 in a little bit lower price market and a normally supplied market. Normally silver should cost anywhere from $1.75 over the silver price, $1.50 for generic rounds to $3 for sovereign minted products. Now,
but not 10.
Double and triple. Right. Yeah, not 10. Exactly.
Not 10. And so the question is if you buy it and the supply issue is temporary, then, then the price would come down or the premium would come down.
Right.
And you have to ask yourself, well, does that make it a good time to buy or not buy? And I don't know. Do you have an opinion on that?
Well, I've always rolled into lower premium items when we've had a situation where silver eagles are as expensive as they are right now. But the fact is that the Royal Canadian Mint, which has backstopped us in the past, like I said, can't keep up. And some of the refineries can't keep up either. It's just the bottleneck is in the fabrication. It's not in the raw metal. It's just in the fabrication. They just can't make enough fast enough. And most of the refineries and manufacturers are not making the bigger 100-ounce bars or 10-ounce bars because their profit margin is greatest on the 1-ounce coins or bars. So that's what they're really focusing on. And they're still not making enough of those because there's a lot of time and effort to make, 1,000 of those. You can make 1,000-ounce bar, it's this big, but to make 1,000 1-ounce coins, you got to make 1,000 blanks, strike them 1,000 times, put them in tubes. So the time and effort is just a lot higher for the products they're focusing on right now, primarily. And this is not going to, like I said, this is not going to abate anytime soon, and the premiums are probably going to go higher. So there is premium liability if you buy the most expensive ones, but there's not a lot of other great choices right now.
Yeah, and then the big question is whether, how you feel it's going to be down the road. If you look at the history of the precious metals, silver is still 50% below its all-time high of about $50, which it's hit twice in the past.
Right.
So there's not very many stocks. There's not very many anything out there that's at 50% below its all-time high. So you would think that it has a little bit of upside. Where if you're looking at it from a dollar perspective, to me, I say, well, gosh, it's still on sale. And the long-term trend of the dollar relative to metals means that you're probably going to end up being glad that you own precious metals. That's why we do it. And I'm going to show a chart here in just a minute. We can get into talking about the dollar with what's going on with that. And you mentioned yields. And maybe if you take a minute, because I don't know that we covered this in the series, and I think it's an important point. But you said that, you were getting higher yields on treasuries, basically just for you real estate investors out there. That's just the interest rate, right? You buy a bond, and what's the interest rate that it pays? It's like if you buy a certificate of deposit and pays you an interest rate. So that's all a yield is. And when yields go up, typically it's because bond prices are going down. They work like cap rates on apartment buildings. So for the real estate investors out there, just understand that. So right now we have interest rates creeping up, and that's been a concern throughout the economy for a lot of different reasons. And everybody's wondering what the Fed is going to do about it. But what you're saying is based on your years and decades in the business, when interest rates go up or yields go up, it puts downward pressure on precious metals pricing. Is that right?
Correct, because you can put money into a bond and get a guaranteed return, but the yields aren't high enough yet to really make that big of a difference, or pressure gold and silver lower than they've been prior to the pandemic yet. I mean, we've had a reset higher, and I think we have really good bottoms that are forming in gold and silver right now. But the 10-year Treasury yield at the beginning of, at the very end of 2018 was 3.2%. It fell all the way to 0.6%, which was negative a point and a half when you figure in inflation. So
in real terms,
negative. Now with the 10-year yield back up to about 1.7%, and it's gone straight up through February. That puts it on par. So the real return is about zero when you factor in inflation. So it's a bad bet to bet on a treasury bond, but everybody's thinking with the economy opening back up again and getting stronger and a bit faster than most people realized, we're going to have 6% GDP in the first quarter, which is pretty strong. Everything's rosy again, but this is a burst of activity that probably will start to wane after we go through another quarter or so of good economic activity in the country.
It's like when you dam up a stream, and then you pull the dam out, you get a big surge, and then it kind of settles down to its usual trickle.
Exactly. That's exactly what I expect to happen. And what's happened to everybody is this economic burst has happened faster, and it's more robust than people imagined it would. We knew it would come back when we got to reopen the economy, but it's stronger and faster now. And that's what made the yields go up so fast, which has pushed precious metals down, which has created a great buying opportunity, actually.
Yeah, if you're in it to accumulate precious metals for the long haul, it's like going in and when you can buy real estate, after a 2008 collapse and you're buying it for below replacement cost.
Right.
You just have to look at the macro trends and say, well, what do I think is realistically going to happen? And, these are the types of things we talk about at the summit, type of things we talk about at the New Orleans Investment Conference. Our friend Peter Schiff has been talking about this forever. People are always like, oh, Peter's always saying doom and gloom, blah, blah, blah. All he's saying is that the major indicators of health for the US dollar are bad. They've been bad. They remain bad. And the prognosis is bad.
Right.
And so if you understand that, then you have to say, well, how am I going to position myself to protect myself? So you had mentioned that when there's fear in the marketplace, people go into bonds as a safe haven, or they go into gold. Those are the two places. But they look at bonds as a safe haven with yield. So when the yield is there, it's like, oh, bonds are better. I would disagree with that. I mean, I'm not saying that you have counterparty risk, but when you get paid back in dollars, you can only get paid back in dollars. Whereas with precious metals, if you own precious metals, you can pivot into any currency. And that there's always a bid on precious metals in just about any currency in the world. And so you can literally sell gold into a stronger currency if you want to. In other words, I'm sure that people who own gold in Venezuela or in, what's that other country that just Zimbabwe, Brazil, you pick it. Those people that had gold and didn't have some bond that paid them back in a currency that was becoming worthless had the ability to sell that gold for dollars. You say, well, they don't get as many dollars, as if they sold it for, bolivars. Well, yeah, but when they sell it for dollars, they actually get something that's usable, so the dollar's always been considered a bit of a safe haven. So precious metals investors are like, well, what if the dollar isn't quite so safe? So I'm going to do a quick screen share here, Dana, and let's move on quickly to the dollar. And then I think what we'll do is we'll close out this section on the commentary, and then we'll come back and do the Q&A so folks can kind of finish this video if they're interested, and then jump over to the Q&A. But let me just share this with you real quick. Okay. I can figure out how to do it easily. Where's my thing telling me what I'm doing? Sorry.
Yeah, one of the other things about precious metals, is gold in particular, it's one of the most liquid investments you can ever have.
Yeah, and it's got no counterparty risk.
Right.
You don't have to worry about that. I mean, if you look at last year, you say, well, gosh, okay, so treasuries were yielding, 1.5 or 1.4 or whatever, safe haven, but gold appreciated by 25%.
Right.
Didn't pay a yield, but it did pretty darn good on capital gain relative to dollars. And if you do that inside your IRA, there's no tax.
Right. And holds its purchasing power much better over a long time.
Yeah.
Right.
And so this here is from the Federal Reserve. They're Fed, they call it. It's the St. Louis Fed, and they crunch all kinds of data. So if you're not familiar with that, but this is the M3 money supply. And I won't bore you too much, but I'll tell you where you can kind of get a primer on what that is. If you go to Investopedia and you just look at what is M3, they'll tell you it's a measure of money that includes M2, which you can look up, as well as large deposits, institutional money market funds, short-term repurchase agreements, repo. And that's something we've been hearing a bit about because a lot of cash got dumped by the Fed into the repo market starting back at September of 2019.
Right.
And it still continues to be a place where there's been a lot of demand for dollars. And there's a lesson in that I want to come back to. And so they also define M2, if you want to know what that is, and it's elements of M1, which they no longer report, by the way, which is basically just how many dollars, and it's almost like physical money, not quite, but M1 includes cash and checking deposits and all that. So M2 includes M1, and M3 includes M2. Okay. Right. So M3 is kind of like all the money there is. And so if you go over here, and the blue here is the United States. Now just look historically, going all the way back to 1970. Does this look like something unusual? Does that look like an anomaly? And then you look at what's going on with Euro, and you look at what's going on with Japan, and yeah, they're both going up too, which means they're weakening their currency. They are printing lots of money, but the United States is in a league of its own.
Right.
And so you have to say, well, okay, it just basic law of supply and demand says if you increase the supply of something without increasing the demand of it, then the value goes down.
Right.
Right. And so you have to say instinctively, you'd say, well, this thing looks like the value should be going down, but it's not.
Right.
And you say, well, how come the dollar is purportedly strong? And so I had a theory we talked about when we were off mic, and I'll stop the share here real quick. But I said, well, okay, so I'm trying to figure out where's this demand for dollars coming from? And I thought about what happened in the repo market, and we wrote about that back when it happened. I think we did a session with Chris Martenson, and we just said, we don't understand fully what's going on here, but the Fed is pumping tons of dollars into the repo market. And just a quick explanation. And George Gammon actually does a really good job on his Rebel Capitalist a deal. And we've been on George's show, and George has been on our show. We're probably going to find ways to spend more time with George because he's a very, very smart young man. But he was kind of talking about what was going on with all of that. And I lost my train of thought real quick, Dana. What was I about to say?
Well, you're going into how many dollars have been printed versus the other countries, China and Japan and the Euro.
Oh, the repo markets, the repo market. So the repo market is like a pawn shop. That's the way I define it.
It's an overnight place to.
Yeah, you're short on cash. You're short on cash, and you show up in the repo market and you post collateral, usually treasuries, so that you can get cash, and then you go back and you pay back the loan with interest and get your collateral back. So I just call it like a big pawn shop for major players.
Yeah, it's overnight lending, basically.
Yeah. And so at one point in September of 2018, that rate got over 10% in a market where interest rates were like less than 1.
Right.
And so they're saying, okay, this is 10 times more risky. So that makes you wonder why aren't these people doing it? And so there was obviously a big bid on dollars. And so to answer that, the Fed was pumping in like $200 billion a month, or at some point, I mean, in like 1 week or something, they put in this ungodly amount of dollars. And so anyway, I took that lesson and I looked at this situation. I thought, okay, I know that when interest rates go up, it's because bond values are going down.
Right.
Okay. And I know that bonds exist on the balance sheets of major financial institutions as assets because it's an asset. They're going to receive, somebody owes them the money. And that in managing their balance sheet, these major institutions like to pledge those treasuries as collateral.
Right.
They hypothecate them, if you will. And so now when they take that money and invest it, they're leveraging, and they're taking these little tiny gains and they're magnifying those gains through leverage. The difference is, like, it's the same thing we do in real estate. We put 20% down to get 80% of the money from the bank. And if the property goes up 5%, we get 5% on our 20%, but we get 5% on the bank's 80%. So our overall growth on equity is like 20, 25%. So
right.
That's why we do it. Well, they do the same thing. The difference is in the bond markets, when the value of the bond goes down, they get what's called a margin call, just like you do on your stocks, which means you have to post more collateral or you have to bring cash.
Right.
And so the problem that's going on right now with rising interest rates is you've got falling collateral in a highly leveraged system. And I feel like there's margin calls happening we can't see. And the Fed is creating a lot of dollars to meet that demand. And it's mitigating. It's not a reflection of like a booming economy and a strong, healthy dollar. I think it's a reflection of a fragile bond market, the same thing we saw in 2008, and the Fed trying to stay in front of it. That's just my theory. I could be 100% wrong. You had a little bit of a different take, Dana. So why don't you explain kind of what you thought going in, and then you can poke holes in what I'm saying.
Well, you think the dollar will fall because we're printing so many of them. Fundamentally, you're correct. It's just that we're going through this reopening phase, in my opinion, that is generating higher than normal gross domestic product. GDP is about 6%, as I said.
With printed money, with stimulus checks, right?
Exactly.
So it's a circular loop that just continues to weaken the dollar. So to me, it's a temporary spike in dollar strength, which means a temporary dip in precious metals, which means it's a sale.
Buying opportunity. That's exactly right. Yeah. So this rising yields is helping to buoy the dollar a bit, which is underperforming relative to what's going on otherwise. And that's because we do have this gigantic Achilles heel of debt, which is just growing astronomically. And as President Biden has recently reaffirmed, he wants to throw a lot more money at this than anybody ever imagines with this infrastructure program that's coming. And our debt is just going to continue to explode higher, which is bad for the dollar. Just that we're going through this temporary phase of abnormally high growth, which is kind of clouding the situation that's really underlying the whole equation, which is stimulus money is helping to propel everything higher. The Fed is doing nothing but trying to fill the hole that the COVID closures have created. And once that hole's kind of backfilled a little bit, we're going to fall back down again. And I mean, this is a recipe that's ripe for a much weaker dollar and much higher precious metals prices when it's all digested.
Yeah. So I think that anybody that wants to be in bonds is probably taking a heck of a lot more risk than they realize. I don't think that there is even a comparison between bonds and precious metals as far as a safe haven. And if I have to have equity on my balance sheet between real estate, bonds, cash in the bank, or precious metals, my vote is precious metals. And I just don't think enough real estate investors understand it, which is why we do these series. So, okay, so that's all good. We could go on, but I think we've been at this for a little bit. Is there anything else, Dana, that you wanted to talk about from a market commentary perspective before we wind down this segment, and then we'll come back and do the Q&A?
Well, it's just the driver for precious metals right now, inverse driver, has been the rising bond yields. And they've made a big gain primarily in February, which caught everybody off guard. Higher interest rates. The stock market doesn't like higher interest rates. The stock market does like more stimulus. So there's going to be a pull and a push on the stock market with more money coming in to help buoy it. But higher interest rates are going to probably mitigate some of the gains that could be there. So this is a really overvalued market. It could run a little bit hotter, but when it breaks, it could break pretty hard. And if you want to follow whether precious metals are going to change direction, just watch the bond yields, the 10-year treasury as a bellwether. That's really where the big driver is. And I think we're getting closer to a top than we are not. So I think we're bottoming in precious metals. We may see one more little dip below base levels we've had already, but not by much. So
yeah, it's the same thing in mortgages. If you want to know where mortgage rates are headed, pay attention to the 10-year. But here's the deal. We know that mortgages are super important to the Fed because they buy billions of dollars of mortgage-backed securities every month. So they're injecting money into the real estate market to protect the collateral. And it's the same reason they inject money into the bond market to protect the collateral. Right now, the collateral, the treasuries are falling because yields are rising. I don't think the Fed has any choice, but they're going to have to print money and prop up that bond market and drive those yields down. And what you've got is a cancer called uncontrolled growth, expansion of currency. And just like any organism trying to find places to contain the cancer, you're getting these tumors. And so this is an opportunity to recognize that, we may put up some numbers and we may look okay, and we might have a good temperature, we might have a good body weight, but there's stuff going on systemically, as Peter has been telling us for ages, and I happen to agree with him, that are very, very concerning. Now, the good news is real estate is a great tool because you can use debt to acquire an asset that produces cash flow and tax breaks. And if you do it right, you can create equity through a rehab or through property management. You can harvest that equity and then you can move it into precious metals, which is what the whole precious equity strategy is all about. But ultimately, if you want the safest place, in my opinion, it's just my opinion, I'm not giving you financial advice, but I think if you want to have a chunk of your net worth parked someplace where you feel it's going to be safe against currency expansion by all players, and you're going to have the ability to pivot into any currency and not have to worry about counterparty risk, I think that there's a real strong case to be made and a place in your portfolio for precious metals. So if you're not up to speed on it, watch our Silver series. I think we did a pretty good job, got some good comments on that about how precious metals work, but in particular silver. You can order, Dana wrote a guide to investing in precious metals, which you can get just by simply sending an email to preciousmetals@realestateguysradio.com. We'll put all the links in the show notes below, so it's all down there. But these are all available to you. Dana's been on the Real Estate Guys radio show many times. We've done these videos together. He's at the Investor Summit that we do this summer, along with Brian London. And of course, he's at the New Orleans Investment Conference. So again, I encourage you, if you're a real estate investor out there, you're watching the show and you don't understand precious metals, I think now is the time to get yourself up to speed quickly and understand the role they can play to insulate your portfolio from what has got to be a pretty severe decline of the dollar. When this breaks contain and makes it out, the fact you see it in the lumber prices, you see it in housing prices, you see it in food prices, you see it in energy prices, it's already broken contain. And, it kind of goes along slowly and then boom. And that's what you see in that chart we showed. It goes along and then boom. Right. That is like that's not like a subtle little thing. That's not just a steady decline. That is like, oh my God, let's put the electric things on the heart and boom, give this thing a shock, see if we can get the heart beating again. So wanted to bring it to your attention, and we did. So Dana, I'll give you the last word and then we'll wrap this thing up.
Well, one thing we didn't touch on were our inflationary pressures, and you just touched on those as well. So we may be transitioning from a deflationary environment into a more inflationary one, which is good for precious metals as well. And if the dollar declines, that's fundamentally inflationary, which means your savings will get evaporated. And precious metals are an excellent hedge against that kind of a negative force for currencies. So,
yep, absolutely. So folks, if you've got questions about all this, and I'm sure you do, of course, you can always contact Dana. We'll have his contact information down below, but you can submit your questions because we're just going to continue to do this. So we're going to break this section now, and then we're going to pick up in the next video, and we'll be taking on the questions that we already got from the audience. So Dana, thank you so much for doing this segment, and we'll see you in the next one.
Thanks, Russ. Always a pleasure.